Good morning, everyone. It's Stuart Williams speaking. Welcome to our monthly webinar. It's actually our last webinar of the year, so I'll just start with a thank you, actually, in case we run out of time at the end. Basically, just to say thanks, everyone, for continuing to log on. Thank you for your support and in your interest. So today we've got Alakara from the Global Equity team in Edinburgh, and then we've got Michael Sherrock, fresh out of the earnings season, and Matt Johnson will finish off. And he may go a little bit over time just with his content for setting the scene for the year ahead. Speaking of setting the scene, pretty much straight to you, Alakara, and fresh off the back of budgets and alike, and a bit of like, we said we wouldn't do this, but look, we have. So you might want to save that till the end. And just a reminder to everyone online that the Q&A function is running. We're recording it, and for any press online, just contact us or Jez, and we can arrange any excerpts. So Alakara, it's over to you. Thank you very much.
Thank you. That's great. Good evening from Edinburgh. I know it's morning time with yourself, so thank you very much for listening in. And certainly, it's been interesting times within the markets, but it's also been very challenging. Certainly, if you're within the quality investing space, obviously that's where we sit. So let's dive straight in, if that's okay, and we'll talk about we'll discuss the strategy, and we'll kick off with performance because I think that's the important one to address. And it was a really difficult quarter, this Q3, for the strategy, which underperformed by just over 6% on both an unhedged and, on the next slide, the hedged basis. So that really turned what were pretty decent numbers into poor ones. And although we have been told others have done worse, this is of very little comfort to us and indeed our clients. Although we're not happy with the outcome, we are fully aware that there are several style headwinds that it can explain the majority of the underperformance, and I'll talk through some stock specific reasons as well. But really want to give you the main messages, and really the first one is in current markets, AI continues to dominate, and really liquidity is flooding into the markets. We've seen a large rotation away from defensive, high quality stocks or areas into and highly speculative growth in the US and value outside the US. So quality as a style has delivered the worst 12-month performance in nearly 2 decades. So it's been pretty dire, which is creating, on the other side, opportunities in areas which are currently unloved or out of fashion, such as areas within healthcare or US insurance. And I'll go on and talk about some areas that we've been looking at as well. But I wanted to just really just paint out those kind of main messages before we go into a few more details within this presentation. So if we could turn on to the next slide, please. Sorry, the next one, slide 4. What else have we observed into the market what else have we observed in the market that is really important? And in the last 12 months, economies have been slowing. They've been hindered by geopolitical uncertainties. We've had tightening consumer finances. US consumers are under considerable pressure. Chinese and consumption has been, far reduced as well. And GDP seems to be holding up. But why is it holding up? And that's because AI has been dominating that. And you can see on this chart that I've put on in this pack, where you can see that AI is now generating 40% of US GDP for the second quarter this year, which is staggering and very different from other eras in terms of, tech boom in 2000. The best performing sectors year to date have been, unsurprisingly, technology, communication services, industrials, and utilities. And I'm sure you can appreciate these are all at the center of AI. Um, Interest rates, they are falling as well, and liquidity is high. So within growth, there've been higher returns for companies with far more speculative drivers. And you can see that within the performance of certainly IPO ETFs, or even, the share charts that I've put on this slide here on the right-hand side, where you can see Tesla and Palantir with PEs in the hundreds. And that's certainly eye-watering. Let's move on to the next slide, and I'll make a few more comments if that's okay. So the net result has really been that continuance of performance for growth companies within the US, driven by AI, driven by lower interest rates, whilst quality everywhere has been completely out of favor as we've seen this style rotation. And that headwind really came into a much sharper focus for us and the performance of the funds in the last quarter. Um, let's let's talk a bit more about in terms of what's been driving the stocks in terms of the better performers and the weaker ones, so we can give you a bit of a flavour as to what's been going on with the portfolios. So if we move on to slide 6, please. Um, we do continue to benefit from having our overweight positions within AI CapEx related firms, and they continue to deliver that alpha that we're looking for. And that's illustrated by the inclusion of Amphenol, Broadcom, Nvidia, and Oracle. You can see all within the top 10 performers of the fund, which has been fantastic. Our other winners, just to highlight a few, because there have been things that are been going well within the portfolio, include Trip.com, and they benefited from rising travel within China. This is a capital light business model, so a highly profitable business when you see the growth coming through. Sony, which completed a spin-off of its Sony Financial, which is a much lower returning profile part of the business. So this was further confirmation of the journey of improving returns within a Japanese company and exactly the type of future quality businesses that we look for within our investment philosophy. You can also see several banks here within the better performers. And this, again, is a reflection of the relatively low valuations and the favorable yield curves that we're experiencing currently within the markets. But let's talk about some of these losers because I appreciate that obviously in times of underperformance, we really want to find out, what has been driving that specifically within the portfolio. And whilst we don't manage the portfolio against mega cap weightings, what we have seen is that last quarter, that recovery that came through within Apple, Alphabet, and Tesla, they together accounted for over a quarter of the underperformance, which is fairly significant. We also had several of the stocks that were out of favor, those stocks that were dominated with low volatility, defensive type stocks. And these included issues such as India's continued headwinds regarding AI and tariffs, which impacted HDFC Bank. Interestingly, India has been referred to as an anti-AI play. And so that narrative is certainly a headwind for quality investments such as HDFC. US insurance companies as well. We have three names within the portfolio. Progressive, we've got Ryan, Specialty, and we have Palomar as well. And they were all sold down as investors taking profits because these stocks were very strong last year and at the beginning of this year. And investors rotated into more capital market focused investment banks. The insurance companies are now trading at 5-year lows, and we believe that they still offer exceptional value in markets with very attractive growth characteristics. So we still feel there's opportunities within our portfolio for alpha generation into the future. There were also two individual stock picks that had poorer profit updates, such as health insurance business Elevance and taste and nutrition business Kerry. And we continue to review these, and we've actually sold Kerry during September as we concluded that really that growth challenge faced by the company is unlikely to improve in the near future. So we divested that. Before we move on so I can give you an idea in terms of the changes that we've been doing within the portfolio, because I think it's important to see what work we've been doing and what changes we've been applying to the fund. I thought it was a useful reminder on the next slide to remind you what we look for. When we're investing in future quality companies. They are those that can attain and sustain high levels of cash flow return on investment. So on the chart here, again, it's focusing on those with the highest quintiles or those with improving fundamentals into the highest quintiles. And they have the better chance of being able to deliver those superior returns over the longer term. We also use those four quality pillars, the quality pillars, to help us. These are, franchise management, balance sheets, and valuation. And out of those four pillars, valuation is probably the most challenged in today's markets, and where we've been seeing obviously speculative trades really shifting up the valuations. What I'll do now is I'll just highlight some of the trades that we have done onto this next slide, please. So over the period, I mentioned we before I talk about Toast, we exited the taste and nutrition business Kerry. We also took profits from some of our AI winners. They had done very well over that Q3 period. So when we did have instances like when Oracle's shares in September soared by 30%, again, that process kicks in where we look to take back some of that profit. But that also provided funding for some of our new investment ideas, and they included a retail point of sale software provider called Toast, which I'll talk about in a second, but also another business, which is a leading Japanese digital bank called Rakuten Bank. But I'll talk about Toast first. It's up on the slide. There's a lot of details there, so I'll not go over everything. So I'll just give you a brief flavor as to what this business is. But it specializes in software and point of sale within the US restaurant industry. So it is driving market share, and profitability is coming from that operating leverage as it expands its location and drives other software verticals, other services that it can provide to its restaurants, its clients. So that flywheel effect from the local successes, such as restaurateurs spreading the word to their peers, is helping them kind of gain that growth of new business. So our numbers, if you have a look on this slide, and this is very much again in line with that philosophy and the process that we implement, our numbers have this business at the beginning of its cash flow return on investment evolution. So you can see that chart on the right hand side there. And the inflection point was really 2024. So we are expecting these returns to shift from, the low teens to up to 20%. And we're confident this business will continue to deliver compounding growth at this double-digit level as it's continuing to be able to deliver that strong operating leverage. And it's also a very good diversifier in terms of the portfolio as we're looking to build diversification and breadth within the portfolio from a risk aspect. We've also actually been able to add into this position and continue to build it up as the stock has been a little bit weaker as well. Again, because of obviously this style shift that we've had in the market. The other stock I would like to mention on the next slide is Rakuten Bank. Now, this one, I'm not sure if you've heard of before, but it's one of Japanese fastest growing banks. And what's different about it is it's a pure digital bank. So it has structural advantages versus its peers. And as a result, it also attracts a slightly different demographic skew when compared to others as well. So over the last 4 years, its account growth has been growing at a roughly about a 12% CAGR. And given digital banking in Japan is only 4% of the market, Rakuten Bank has plenty runway for further growth. So you can see there's a structural opportunity for this business to continue to gain share and grow its business. It also has a leading cost to income ratio in the industry at 30%, which is very attractive. So it is a very profitable business. So it's benefiting from the tie-up that it has in terms of the e-commerce giant within Japan, Rakuten, providing services to their customers, offering them accounts services, but also offering them rewards benefits. So the next and certainly more powerful leg of the journey for this business is for them to convert those digital accounts from Rakuten customers into main accounts, and they're able to generate 6 times the profit um, on this, sorry, the revenue on this. So at the moment, it generates 18% return on equity. We think that cash flow return on investment, that chart on the right-hand side, you can see on the slide, um, we expect that it can lift its CFROI from about 14 to 17. So again, another welcome diversifier to the portfolio. So we've gone through quite a few of the updates in terms of the main kind of laggards, the performers, and some of the newer names that we've done in the portfolio. And I think it's important to give you a bit of an outlook. As I've already said, and thank you on that's the right slide, risks and evaluations are elevated. We're very acutely aware of that. Um, there are many warning signs that are suggesting that investors should tread carefully. Shares in private equity companies continue to underperform. You can see that on that top left-hand chart here. Whilst financing the AI boom has now shifted from hyperscaler balance sheets into private debt markets or even suppliers of chips such as NVIDIA. So the latest funding round for OpenAI with a $500 billion dollar valuation tag, despite huge cash burn and losses, suggests that all-in approach across the supply chain, and there's a lot of circular deals that are also raising concerns there. On the next slide, think it's very important to also point out the current concentration within the markets. And it is an unhealthy dynamic. NVIDIA obviously already topping between 4 and 5 trillion. It did hit five, bigger than the whole of the MSCI energy sector combined. It is significant. It's mammoth. Today, the significant data center and AI build out will likely lead to falling returns if um, as excessive capex spending normalizes, which it will eventually do. So our view is not if that happens, but when it will happen, because you can't keep plowing that amount of billions into something until you realize that you're actually going to get those returns coming through. Um, but these warning signs don't mean the bubble that everyone's been talking about, the AI bubble, will burst soon. The irrational market behavior could well persist for some time. And meantime, we'll have to look for the opportunities that emerge. What I'll do is on this next slide, I'll give you the how the portfolio is shaped. And what we've been doing is diversifying the portfolio away from AI and into higher quality, more predictable growth franchises. And up until the end of July, this has worked out okay. But in the last few months, we have experienced a significant derating of lower volatility, high quality companies. So this has been wrong in terms of our timing of that. And certainly we put our hands up to say that we've got that wrong in terms of coming out of AI too soon. We still have exposure within the portfolio, but to a lower extent. So we've not been able to participate on that upside as much. We're at a time where the market environment doesn't favor future quality investing. Um, but when the reality of high valuations and elevated risks, or when the AI rocket slows, if you want to call it that, those high quality compounders we believe, will come back into favor. Um, and so in the meantime, we believe the scale of the rotation that we've seen is really been creating opportunities to add to future quality stocks that are being ignored or unloved at the moment. So it's very much a case of believing that our focus on the four pillars that I mentioned earlier in terms of franchise, management, balance sheet, and valuation, sensible valuations, will provide that long-term value for our clients. And we see very little gain in terms of paying up when markets are showing such excessive, exuberant, speculative behaviors. So really what you see here is a portfolio of truly diversified stocks with multiple growth drivers for growth over the longer term. This isn't our short-term calls. We are long-term investors. So, what I would like to do is to thank you for obviously your support and commitment, and assure you that we are fully committed into the future quality philosophy and investing in quality businesses with the highest potential for future returns and alpha generation. Thank you very much, and I'm happy to take any questions.
Thanks, Alakara. It's a great presentation and a great reminder of why we appointed you and the importance of sticking to your knitting and that adherence to future quality and philosophy. So yeah, it's awkward for everyone and anyone when when the style is on the fringes of what the market wants. I have got a couple of questions related to AI in the first instance. I think you talked a little bit, or I guess the basic question for NVIDIA is, so you've got an active weight in at the moment. Has it presented opportunities to top up and sort of top and tail it? And if so, have you been able to avail yourself of that? And I guess we observed that you are overweight at the moment, I think you said.
Yes, that's correct. We do have an active weight within the portfolio at the moment. Our AI weighting is a constant topic of conversation and active debate within the team. It happens multiple times a week, and actually, I think it's next week. We're all sitting down for our official stock ranking meeting, where we officially would, look to try and organize any trades to act on in the fund. NVIDIA, obviously the scale of the kind of the weakness within the share price is certainly raising kind of those questions as to whether this might be an attractive point to potentially to potentially top up. But equally, we have to obviously assess the entire AI weight within the portfolio to make sure that we're comfortable with the exposures that we have across the value chain of AI exposures. NVIDIA is also quite a sensitive stock at the moment, let's say. And obviously the recent news in terms of Alphabet selling CPUs directly to Meta by 27 is, that's causing concern in terms of it's not losing its relevance, but clearly the risk of weaker margins, lower market share is also creating other questions as well. So I think we need to convene and have these discussions as to the risks that we're willing to take on board, and if we want to do any obviously active top ups or trims or shifts into other directions. And that's I can't give you any hints, but that's the active debate that's going on. But it's a great question, and they're the ones that we are having around the desk.
Yeah. Okay, thank you. Hey, one other thing which I might have inferred incorrectly potentially from what you were saying about I guess open AI and private markets. Could we infer, or could you put some meat on the bone of whether there's like you're watching that private market funding mechanism really closely to ensure that they gain or continue to be supported well? And I know even in our team in New Zealand, there was certainly discussions about the switch from equity funding to debt funding and private market placements, for example. So I think was that the reason why you included that chart about private markets?
I think it's important because I suppose the difference from the tech boom before in terms of everything funded by debt to where we are today, where everything roughly so far has been funded by cash because these are very cash generative businesses. But when they're talking about the hundreds of billions being spent on capex, their cash flows can't stretch continually forever. So they're having to dip into the debt markets. And we saw that with Oracle, concerns in terms of their credits. Credit ratings in terms of within the debt sides, in terms of those ratings coming down, is there slight concerns about that? And obviously, we know that there's a lot of liquidity within the market, and that isn't necessarily going to be stopping anytime soon. And that is quite a lot of hot money that's going around into what we would call as, I suppose, black holes, because they're going into the AI hole of we need to build and we need to build fast because we need supply because there's not enough supply for the demand that's going on. But we are seeing very little, we are seeing limited, sorry, signs of monetization to the scale to be able to cover the original investment. And that's, I think, what comes down to the original kind of an investment thesis questions in terms of, fine, you're paying up for this amazing technology, which, user adoption is absolutely rocketing far, far higher than in any other technology that that's been put out there and finally adopted, which is great. But we don't have enough power.
Yeah.
There was something Ian was telling me around the desk. They were talking about, oh, we'll maybe come up with a solution. This was from a credible person in the investor community. Maybe we could just build out something on the moon, and that will be able to provide us power from solar. I mean,
Wow.
these are just crazy things. Might be possible, but but the fact that these, they're talked about is just quite ludicrous. So I think there's a lot of concern when you are coming into the private side in terms of the volumes that are potentially being raised within that area.
Great. We're a little bit tight on time, but I'll try and squeeze one more question in. So just in relation to Toast,
Yes.
really interesting because is it fair to say that they potentially have a really strong headwind as even the Americans move from their cash money to everything coming online, and it's abundantly clear and quite surprising when you visit the US that they are quite a cash society still. So to what degree, if at all, is that a tailwind as people become more digitally connected with restaurants in particular?
Well, it's an interesting question, and I think that these businesses are so well set up to convert the clients for their customers in the best way, and to try and monetize them even further by providing additional add-ons and services to make things even better for them. And I suppose what we also have to look at is the consumers are just eating out far more. It's very convenient to eat out. Sometimes it can be cheaper than, buying your food out and making it at home. And so there's that ongoing trend. Fine, you might have some cyclicality within that, but there's that ongoing trend for, the growth within the restaurant industry. And this is a business that is being able to offer services which are much superior to a lot of the existing traditional providers. And that's where it's been able to really gather that market share and grow its network of offering it. And then, like I said, it's word of mouth. When
Yeah.
these services are made, makes life so much easier for these restaurateurs. And remember, whether it's fast food businesses or smaller restaurateurs, they're able to provide those solutions.
Awesome, thank you. We're right on time, so thanks for joining us. We look forward to seeing you. Thanks for being on our webinar for the second time, I think. All the
Yeah.
best for the festive period and for your I guess your contemplations at a pretty difficult time. So all the
Yeah.
best to you and your team.
Thank you so much for your time, and thank you for everyone listening.
Great.
Okay,
All right.
bye.
I think we're going to Michael Sherrock next on the back of, or just at the end of earnings season. So you don't need any introduction, Michael. Straight over to you.
Thanks, Stu. Good morning, everyone. Happy Friday. Look, just given this is the last update from us for the year, I thought I might just reflect on the market year to date and go through a few of those bits and pieces there. So just bear with me as I share my screen. Right. Yeah, so just in terms of what I'm going to talk about, run through the NZX 50 year-to-date return, the largest stock moves year-to-date, some international market returns, some comments on reporting season and annual shareholder meetings, some thoughts on the year ahead and how we're positioned in the funds and fund returns. Look, so the squiggly line here is the return for the NZX 50 for the year-to-date. So we started to see a pullback in the market in February, a couple of things driving that, a couple of stock-specific reasons. So the Ryman capital raise and sort of disappointing trading update, and also Spark disappointing result. But probably the key one was during February we started to hear the chat from the US around tariffs, 25% tariffs on Canadian and Mexican goods and Chinese goods. And that had an impact on Fisher Paykel Healthcare in particular, which is the largest stock in the New Zealand market. The expectation was that they were going to be facing 25% tariffs on their goods that they produce in Mexico. Ultimately, that hasn't been the case. They're safe due to the US, Canada, Mexico trade agreement. Certainly at this point in time, things may change. But certainly through February, March, and ultimately April, as Liberation Day occurred, the impact of tariffs and talk about tariffs had a negative impact on the market, and not just the New Zealand market, but globally as well. From there, we've seen a pretty steady increase in the market return from that 10% down. We're now up a touch over 4%, so essentially a 14% swing from that low point. Certainly benefiting from cuts in rates, some of the tariffs being walked back, negotiations around tariffs and pauses on tariffs have been helpful, but ultimately it's been the central banks around the world and for New Zealand, the Reserve Bank of New Zealand cutting rates, which has been very supportive of the New Zealand market. If we just move to the next slide, just thinking about the contributions to the return of the NZX 50. So on the left-hand side, are the five largest contributors to the return over the year to date, and on the right-hand side, in the red blocks, are the five largest detractors. So A2 has been, a standout performer and a large contributor. Nearly 3% of the NZX 50 return has come from A2 itself. And then on those five detractors, those five names account for about 4% reduction in the NZX 50 return. So some very large negative returns, but also some companies which have large weights in the index having negative returns, the likes of Auckland Airport and Infratil in particular, being large weights in the index, dragging the market back from what otherwise would have been a pretty reasonable return for the year. If we look at some of the stocks, the 5 largest positive returns and the 5 largest negative returns, quite a range over the year. So we've got A2 up 76%, got Sky City Entertainment down 40%. So quite a big range there from those the high to the low. In terms of those 5 largest positive returns, key drivers really there have been earnings upgrades and earnings results that have been better than expected, driving those large returns. And then on the right hand side, the likes of Ryman and Sky City, heavily impacted by their capital raises during the year. Kathmandu, or KMD Brands as it's called these days, just facing those tough consumer and retail environments, so driving that negative return. And EBOS, disappointing result, but the stocks have been more driven by the disappointing outlook statement that was delivered at that result. And Serco, just some nervousness really around the outlook for its earnings. It has had a number of very, very strong years leading up to this year, and so a bit of a pullback in that name. On international markets, if we go back to pre-COVID days, the New Zealand market actually was an outperformer versus international markets, or certainly versus the MSCI World Index. So for each of those calendar years leading up to COVID, New Zealand market stronger than the MSCI World Index, and also notably stronger than the Australian market as well leading up to that point. Then we had COVID arrive. We had sort of out of control inflation, and interest rates ramped up pretty aggressively to battle inflation. And that was quite a negative for the New Zealand market, a very interest rate sensitive market, a somewhat dividend yield focused market, and that created some headwinds versus during 21, 22, and 23. In 24, we had the start of rate cuts at the back end of 24, and that drove the market up 12% during that period. This year has been sort of well, I guess the headline 4% return doesn't tell the full story of the actual underlying market returns. You can see the NZX 10 down 3.5%. So negative returns and our large weights in the index have been a bit of a headwind versus the small and mid cap portion of the NZX 50, up 30% for the small caps and up 20% for the mid caps. So if you ignored what was happening in the top 10, the actual return for the market could have been somewhat better than the 4%. In fact, there's only 12 stocks in the NZX 50 that have had negative returns year to date. So the dominance of positive returns has been in the market. And then looking across those other international markets, very strong returns for the equity markets across the board year to date. So hasn't been a straight line, but certainly where we sit at the moment, year to date returns looking pretty attractive for all of those markets. If we just move to reporting season and some annual shareholder meeting comments. This reporting season has been dominated by property securities, so we've had half a dozen, if not a couple more property names report their results. No real surprises there. Property companies doing what they should be doing, collecting some rent and paying that out in dividends. So that's all been good. There has been a couple of property stocks that have raised capital over the last few weeks. So we had Precinct raise some money to fund its development pipeline, and we also had Vital Healthcare raise money to fund the internalisation of its management contract as well. On some shareholder meeting comments, A2, heading into that shareholder meeting, the market was expecting an upgrade, or certainly pricing in an upgrade. The share price had been very strong leading into that shareholder meeting, and an upgrade to revenue was delivered at that meeting. So the share price didn't react too strongly on the back of that. It was already priced in. And also Sky TV, a stock that's close to our minds, given our positioning in Sky TV. Just pleasing for them to reiterate their at least 30 cents per share dividend at their shareholder meeting. And so, that continues to provide a very attractive dividend yield for that stock. And just touching on a couple of the results from this week, I won't go into some from previous weeks, but just we had the Ryman result yesterday, and so that was a pleasing result. Still some work to be done, but all the key metrics heading in the right direction, so that was reasonably well received. And Fisher and Paykel Healthcare, they had their result on Wednesday, a really strong result for their first half, and also upgraded their guidance for the full year. So on the day, that stock price reacted, reasonably well to that update from them. Thinking about the year ahead, look, we've had 325 basis points of rate cuts now. On the back of that 25 basis point cut earlier this week, that's quite stimulatory for the economy. We're starting to see some early signs of some growth. Some of the consumer confidence, business confidence numbers coming out have been good and improving. So 2026 should be a much better year for the economy. It's really just been the lag of those rate cuts flowing through to the economy. The large fixed rate mortgage market that we have here, 90% of mortgages fixed, just takes a long time for people to roll off those rates and get lower rates and have a few extra dollars in their pockets and ultimately spend that in the economy. And those low rates are, supportive of the equity market as well. So as we get economic growth, that flows through to corporate earnings, and ultimately share prices react on the back of increased corporate earnings. But also the sort of relatively high dividend yield of the New Zealand market is attractive, especially when you've seen term deposits nearly halve from their peak of where they topped out as well. So, both those things should be supportive of the equity market as we move through 2026. New Zealand dollar, we've seen weakness of the dollar, depreciation over the year as well. That's going to continue to be supportive of our exporters as we move through 2026, all else being equal, assuming that the dollar doesn't move too far from where it is. But one thing we do need to be mindful of, it is negative for our importers. So, some of those consumer goods that are being imported into the country, may be more expensive. Really comes down to how companies pass on some of those increased costs. Do they absorb that through their margins, reduce margins, or do we start to see a little bit of inflation from that lower New Zealand dollar flowing through? And probably the biggie is the election. So probably less than a year away now, back end of next year, we'll see the election. And as we move through the year and get closer to that, we'll continue to monitor policies that are coming out of the political parties and also the polls. How realistic are some of those policies of being implemented? And so that will be very important. There's a bit of a risk that the economy stalls a little bit as we head into that election period. As we get closer to that, companies will be very, nervous about making investment decisions depending on what the government looks like, what the coalition looks like, and some of those policies that may be put in place. So, a little bit of a risk that we get a slowdown as we get closer to that election, and as those negotiations occur between political parties. Just thinking about fund positioning. So just for our core fund here at the moment, we have our large 5 largest overweights and 5 largest underweights. I won't go through each of these, but just probably to note Kiwi property. If we sat here 12 months ago, we wouldn't have owned any Kiwi property, but just on the back of lower rates, that property sector has become more attractive, and we've built a position in that name and a couple of other names. Really just attractive dividend yields, trading below asset backing, and as we move forward, some of those property revaluations should be positive, driving valuation gains, and also still, despite a pretty strong period for the property names, some pretty attractive after-tax yields still on offer. We're not buying the whole sector. You can see in terms of our 5 largest underweights, we've got a couple of property names there as well, but just playing in our preferred names at this point in time. The retirement sector, so continue to like the retirement sector despite some wobbles during this year. But as we move through 26, the property market should improve. Certainly not calling out rampant house price inflation, but just price activity is probably the most important thing for the retirement sector. Getting sales velocity going for the property sector, the residential property sector will be important for those retirement names, and still very supportive of the long-term demographic support. One other one to call out really is Sky TV. So despite a 50% return for the year to date, still supportive of that name with that very attractive dividend yield on offer. Look, it's been a challenging year. Faced some headwinds early in the year from our positioning in Ryman and Spark, those two names in particular. We've adjusted our positions through the year. We've sold both names down. We've been buying back more recently. So both, and for the core fund as well, Sky City has been a headwind for that particular portfolio as well. I guess importantly, both Sky City and Ryman have had strong returns recently. So both of those names up around 20% over the last 3 months, and some positive momentum as we move into 2026. So comfortable how the portfolios are positioned. And certainly over the longer periods, the portfolios have performed reasonably well. And really just noting that year-to-date return for the property index to the end of October, up 18% in the property fund, tracking ahead of that. So that's how performance stands at the moment. We've got another month to go, get through December, and we'll see how we're positioned at the end of the year. And look, just given it is the final update for the year from our team, just really wishing yourselves and your families a happy holiday period, getting in a little bit early on that. No doubt catch up with a few of you during December, but for those that I don't see, I look forward to seeing you in the new year. So I'll just stop sharing there and pass back to Shu.
Great work with the stick on the beach, Michael. That's you're very impressive writing and artist there. So
I'm quite good with that stuff.
Yeah. All right. We're right on time, maybe a tad over. We'll go straight to. So thank you very much, Mike. We'll go straight on to Matt Johnson, and just fair warning. Matt said he might be 5 or 6 minutes over, but there's a lot to cover at such a critical point turning in the economy. So Matt, straight to you. Thank you.
Thanks, Stu, and kia ora, everyone. Well, we are rapidly approaching an end of yet another year, and no doubt we are all looking forward to a very much well-deserved break with our loved ones over Christmas. And look, I enjoyed listening to Michael just a few minutes ago. I always find it interesting to see the commonalities between the various speakers' presentations, as we don't see them in advance. So you will see that when I kick off this presentation. Now, in keeping with that end-of-year theme, what I'm going to do today is take you through 6 themes for 2026 that the bond team think are going to be impactful. So, without further ado, let's kick that off. And theme number 1 is politics at play. Well, as you're all aware, 2026 is shaping up to be a pivotal year for domestic politics, with a general election due before December of the year. And if you look at the polls today, it is a coin toss as to who would be able to form a government. In terms of the National Coalition, they started off strong in the polls when they entered office in 2023. They have since ebbed away in support and today sits slightly south of 50%. On the other side of the House, the left bloc of Labour, the Greens and Te Pāti Māori have slowly increased in support, initially in a policy vacuum, but perhaps more latterly despite policy being announced. Up the top of the chart, you're going to see some key event dates. You'll see when the budgets were released, when the Reserve Bank started cutting, when the Treaty Hikoi occurred, and most recently when Labour's capital gains tax was leaked. And that last one's probably the most interesting, in that one would have thought that announcing a new tax would see that left bloc slip in the polls a bit. But in fact, if anything, there's a slight improvement in their standing. Now, I'm not going to focus on that tax policy too much as to whether it's good or bad, but rather I just want to draw your attention to a couple of features that we think are important for the bond market and the general economy. And the first is that if that left bloc gets to power, we are going to see a larger bond program. If you think back to Budget 2025, the largest line item saving in there was pay equity. If the left block gets in, that is certainly back on the table. Budget 25 put it at a $2.7 billion cost per year. The next thing is that capital gains tax policy. Now, we don't know enough details about this, but there is an inherent timing mismatch between when that policy would generate revenues and when its expenses go out in terms of those associated doctors' visits. And both those two things together are going to put upwards pressure on the size of the government bond issuance program and likely a little bit of pressure on those government bond yields. The second feature that we should all be aware of is that of uncertainty. With the polls so close, businesses and individuals are certainly in an area of uncertainty when it comes to future tax policy and general legislative policy. And look, uncertainty is no one's friend when it comes to making large investment decisions. Take that capital gains tax as an example. Look, we don't know the details of it, but if we were to look at it from a first principles basis, when you tax an asset's gains, you normally let someone claim interest expense against that asset. We don't know if that is the case today, and at the margin, that might be holding back some activity in that construction and building sector today. So, theme number one, watch the polls. They're going to be impactful on markets. Staying in the same general area for theme number two, but moving across to the US, we have the US midterm elections. And there we're asking ourselves, will Trump's wings be clipped? Now, as it stands today, the Republican Party has a small majority in both the House and the Senate, and that has allowed Trump to pass his various policy endeavours, such as his big, beautiful bill and his various trade policies. In 26, there is going to be elections for both those houses of government. The House of Representatives has 435 seats. The Republicans currently have a majority of 2. Each and every one of those seats is up for election. Given where the polls are for that, it's looking pretty close. It could indeed flip over to Democratic control. Then if we look across to the Senate, it's slightly different there. Senators serve 6-year terms, and elections are staggered such that they occur every 2 years, and around about a third of the seats are up for challenge in each of those 2-year periods. But an interesting thing there is that the mix of those seats is not necessarily proportional to that of the total Senate. Take 26 as an example. There are 22 Republican seats up for challenge and only 13 Democratic seats. Now, you might think at face value that gives the Democrats a better chance of flipping those necessary 4 seats, but you've got to remember a lot of those seats are in true red Republican states, and it would be very difficult to see them moving across that political divide. If you look a bit closer, there's probably 6 seats where the Democrats have a reasonable chance of flipping control. So it is possible that they could get control of the Senate, but it's difficult. Now, what would it mean if the Democrats gained control of either the House or the Senate? Well, essentially, it would see the end of the legislative phase of Trump's presidency. And that means it's going to be harder for the Republican Party to pass bills like Trump's big, beautiful bill or any other trade-related policy, as they'll need to cross the political divide and get agreement from the other side of the House. Then when we think about things like the debt ceiling, we've just been through a period of the longest government shutdown on record in the US. The US will come up against that debt ceiling in 2026. Without a majority, there is going to be more need for compromise with the Democrats, so expect more risk of shutdowns. And then finally, when you have uncertainty as to what policies will be coming in and if they will be modified along the way, that combined with those other 2 features, I think we'll see a bit of volatility occur in rates markets. And the US is the most important rates market in the world, so that will have an impact on our own domestic market in terms of volatility. Now, one thing I found interesting when looking into the US midterm elections is that historically, the incumbent president's party typically loses seats. You'll see that in the charts on screen now. Those red bars in the left chart and the center chart are the number of seats the incumbent president's party has lost in each of the midterms going back to 1934. The other interesting thing is that the number of seats they lose is pretty highly correlated with support for the president in terms of approval. And in the chart on the right, you'll see that Trump's approval rating has been heading south quite quickly lately. So not a great story there when you're running a very small majority. So theme 2, be aware the House and the Senate could flip control in 2026. Coming back to our own shores for theme number 3, we have a new transparent Reserve Bank of New Zealand on the horizon. You'll see a picture there of Dr. Anna Brennan. She starts her helm as governor on the 1st of December and will serve a 5-year term. Her first meeting is in February of 2026. There's also a little quote there on the left from her maiden speech when she was announced as the governor. And there, I want to highlight that she said she's going to strive for transparency, accountability, and clear communication. Now, if she wanted to do that with the Reserve Bank of New Zealand, what do we know about her? What might she do? Well, what do we know about her? She is ex-Riksbank, and the Riksbank has a much more transparent stance to disclosure than the Reserve Bank of New Zealand. There are 3 areas I want to highlight. The first is around policy discussion. The Riksbank attributes comments to individual members. The Reserve Bank of New Zealand does not. Then we have number 2, vote disclosure. The Riksbank attributes votes. The Reserve Bank tries to seek consensus, and where a vote does occur, they do not attribute those votes to individual members. And then number 3, we have press conferences and general media availability. The Riksbank has press conferences after each and every of their 8 meetings of the year. The Reserve Bank of New Zealand has them only after 4 of their 7 meetings, being the monetary policy statement. On top of that, the independent committee members of the Reserve Bank of New Zealand have been decidedly absent in public speaking engagements. And as such, we don't know where they stand as well as we perhaps would like to. So that might change under Dr. Bremann's stewardship. Now, to make any of these changes, she is going to need the support from our Finance Minister, Nicola Willis. And in that regard, earlier in October, in an interview on Bloomberg, Minister Willis suggested that she is in favour of allowing her to make those changes. And then finally, thinking about Dr. Bremen, you might be wondering where she sits in terms of that spectrum from hawk through to dove. Well, we haven't heard her speak yet on our economy, but we can look to her voting record at the Riksbank. And there we see she voted 35 times, 33 of which were with the consensus, and 2 were dovish dissents. So perhaps at the margin, she is a slight dove or a mild dove. Now, what does this mean for markets? Well, as we go through this transition to a new communication and open framework, there may be a bit of volatility in how we interpret the Reserve Bank's messages, particularly if we get a point where there are opposing views of committee members that are now out in the public. So watch that space. There may be some volatility, but in the longer run, this is probably net a very positive thing for the Reserve Bank of New Zealand. Staying on our local shores for theme number 4, we have green shoots to blossom. Now, 2025 has been a challenging year for the economy, but when we look forward, we have every reason to believe 2026 is going to be better. Take business confidence as an example there. It's at an 11-year high and up towards the top end of what can be seen over the past 20 years. So businesses are feeling better. Then when it comes to the consumer, they are still in pessimistic territory, but there is certainly a trend of improvement there. And so we're asking ourselves, where might we see those green shoots start to blossom? And on screen now, you'll see 6 charts, which I believe does show those green shoots blossoming. Top left, we have the composite PMI. Yes, it sits below that magic 50 number, but there is a very strong trend upwards from when the Reserve Bank started easing. We can look to retail card spending in the middle. Exact same story there. We have a strong upwards trend from when the Reserve Bank started easing. Top right, we have the ANZ truckometer. This is a fantastic indice that shows movement of freight around the country. That is indicative of economic activity. It has a really strong correlation with GDP growth, and you see a nice upward trend occurring there. Bottom left, we've got the ANZ Business Survey, and that was updated just this week. A nice big jump up there. It really affirms that story from the truckometer that economic activity is picking up. Then bottom centre, we have a building consents. And you'll see that nice little uptick there in the circle. Now, not all consents eventuate into construction activity, but basically the more consents we have, the more potential future activity we have in that construction space. And then finally, I've got rolling annual vehicle registrations. And once again, in that little circle, you'll see we've got a nice uptick developing, showing that businesses and individuals are feeling confident enough about life to open their wallets and replace vehicles. Now, before we move forward, I want to go over one slightly light-hearted measure, and that is Google Trend data. On screen shortly, you're going to see the relative interest in two search terms, builder and renovation. And what you'll see there with builder is that it's been trucking along, and then recently it has shifted up to its highest level of relative interest. We've got a similar story for renovation, but look at that big increase recently. And when you look at the timing of those increases, well, to me, it looks like they're occurring when the Reserve Bank moved into stimulatory territory with its monetary policy. Now, if you are going to look at these over that Christmas period, just be aware that there's a pretty strong seasonal trend to the data. You'll see it typically ticks down in December. So, theme 4, green shoots are developing. Keep an eye on them over 2026. Theme 5, and this is probably more valid today than when I put the presentation together earlier in the week, as we've just had the Reserve Bank deliver an update this week, and that is the theme of needing to adjust our thought process from how low the OCR is going to go to how long it's going to stay at what is stimulatory settings. Now, if you look back historically, at the end of an easing cycle, one should expect the cash rate to be kept constant for around about 1 year. And you can relate that back to the average time it takes for monetary policy lag to come through to its maximum impact, which is around about a year to 18 months. Then, referencing back to the start of this presentation, we talked about the general election. Around the world, it seems pretty poor form for a central bank to move their policy rate either up or down just prior to an election. And with that election occurring in December of next year, that is pretty close to 1 year in the future. You'll see market pricing for the OCR in the chart there on screen on the left. I don't want you to be too focused on whether it is 2.25 or 2 as the point, but rather just note that it's whatever that level is, it's probably staying around there for around about a year. Now, just because we've come to the end of an easing cycle, it doesn't mean we necessarily need to be immediately concerned that interest rates are going to go up for all those reasons I've just covered there. And in that regard, we should also be comfortable taking on duration as we have really strong carry on offer. Take a 10-year government as an example. Today, we're looking at a yield of around about 4.3%. That's fantastic carry over an OCR of 2%-ish, particularly if we believe that that is not moving over all of 2026. If you wanted to take on a little bit less duration, we could look to the 5-year point. There we see a 5-year government bond is 3.6%, or if you were happy to go into the credit space, a 5-year bank is around about 4.1%. And that's great carry once again over where the OCR is likely to be for most of 2026, if not all of 2026. The next thing I'll point to is those curves are actually really steep, and a steep curve is a bond manager's friend. How steep are they? Well, the chart on the left there shows that they are indeed steep relative to their own history back over 20 years. That orange line there shows the average level slope between the 2-year point and the 10-year point, whereas the black dotted line is the average level slope if we only look at the pre-COVID level. So pretty good slope relative to its own historic levels. And then we have, you might be asking, how does our slope compare to that in other key markets? And the chart on the right tells that story. You'll see that we have twice the slope of what is on offer in Australia and over 3 times the slope of what is on offer in the US. So there's great opportunities to target carry and benefit from roll down. Now, if you are still concerned about that front end starting to move up, I think perhaps something that should give you a bit of comfort is if the Reserve Bank does start to move up that cash rate, we think that's going to express itself in the curve flattening a bit, with the front end shifting up initially and the back end moving up perhaps a little bit less or not much at all. So again, that should give you a bit more confidence in taking on that position. Then we come to our final theme for the day. And, just because the easing cycle is at the end, it doesn't mean that the domestic bonds have lost their value as part of a diversified portfolio. Now, we often beat ourselves up in this country about how poor our government is and how the bond program is ever increasing in size. But we must remember we are a AAA credit here in New Zealand. And if you look at that debt level and compare it to key global alternatives, you will see that we are meaningfully lower. And I'll point to the US, the UK, Japan, or France as alternatives there. So if indeed at some point in the future we move to a world where debt is indeed seen as potentially a little bit unsustainable, it might come through as a challenge in those markets before our own market. Then thinking about the credit side of New Zealand markets, we have a very high credit quality market here. Many of the companies and entities that we are financing have very defensive businesses. They might be running essential infrastructure. They might be regulated entities such as line companies, or they might be government adjacent such as social agencies or councils. And that defensive nature means we see a bit of stability in those credit spreads on offer through the cycle. So we think that strong, high quality is really a positive feature of the market. Then look, I've got to go over it again. The slope of our curve here in New Zealand is really steep. That is a great return driver for any bond manager. We've got great carry, we've got great roll. That is a positive feature. And then finally, look, you might be wondering, how much should you have allocated to global assets as opposed to domestic assets? And I don't want to be too biased here, but for the reasons I've just mentioned, we think domestic assets stack up quite well in terms of fixed interest. But in addition to that, you should be aware that if you were to hedge foreign assets at the moment in terms of fixed interest, you're looking at some pretty expensive hedging costs. Take an Australian bond as an example, you're looking at a hedging cost of around about 1%. Or if we looked across the US, it's probably slightly higher than that again. So by staying domestic, you avoid that ongoing hedging cost. So there we have it, 6 themes for our 2026. We have the general election, watch those polls. We've got the US midterms, will Trump's wings be clipped? We've got a new transparent Reserve Bank of New Zealand. Let's see how that plays out in terms of communication. We're watching those green shoots, waiting for them to blossom. We're asking ourselves, or changing our thought process from how low the OCR is going to how long it's going to stay at symmetry territory. And we just want to remind everyone that we still see good value in domestic bonds as part of a diversified portfolio. And I'll stop there and see if there's any questions.
Hey, thanks, Matt. That was awesome. We've got a nice roadmap to check in against for the year coming ahead. I think that we're a bit over time, so we'll stop there. There's no questions online, but we'll close again by just thanking everyone for their support through the year, and wish you all a safe time if you're getting a break, and enjoy time with your family. And we will see you again early in the new year. Travel well and be safe. Thank you very much.